What if I told you the stock market has a calendar, and for 70 years it's been one of the most reliable patterns in finance? Not astrology, not technical squiggles. A simple observation: the market behaves differently depending on which year of a president's term you're in. Year 3. Historically the best year to own stocks, positive almost 90% of the time. Year 2. Historically the worst, the year of the deepest crashes and the biggest buying opportunities. And here's why you should care right now. As of this recording, we are in year 2. In the next 8 minutes, I'll show you the pattern, why it exists, how the current administration broke it in a way nobody's playbook predicted, and what the calendar says comes next. First, the pattern itself. It's called the presidential cycle, and the numbers since 1950 are stark. Year 1, the post-election year. Modest, choppy returns while the new administration does its unpopular work. Year 2, the midterm year. The weakest average returns of the cycle and the deepest average drawdowns, pullbacks approaching 20%, are normal. Year 3, the pre-election year. The monster average gains in the mid-teens, and it's been positive nearly 9 times out of 10. Year 4, the election year. Decent but nervous. Why would stocks care about a political calendar? Because policy follows it. Administrations are rational. They front-load the pain, spending cuts, tax hikes, tariff fights, tight budgets, into the first 2 years when the next election is far away. Then heading into year 3 and 4, the stimulus taps open, spending flows, deals get announced, everyone wants the economy roaring on election day. The market isn't psychic. It's just front-running the oldest incentive in politics: get re-elected. Layer the seasonal calendar on top and the old rules multiply. Sell in May and go away, because historically, almost all of the market's gains came from November through April. September, statistically the cruelest month. The Santa Claus rally in the last week of December. None of these are laws of physics. They're crowd habits, printed in enough decades of data that people trade them, which, for a while, made them self-fulfilling. And then came 2025, the year the calendar broke. A returning administration took office and did something the cycle never accounted for. It governed by announcement, at maximum speed from day one. In early April, the heart of what should have been quiet post-election drift, sweeping tariffs were announced on nearly every trading partner at once. The S&P fell roughly 20% from its peak in a matter of days, one of the fastest corrections in market history. Trillions in value gone between a Wednesday and a Monday. That's year 2 pain showing up a year early, delivered not by a business cycle but by a press conference. Then the second half of the anomaly, the pause. Tariffs delayed, deals floated, and the market didn't just recover, it ripped. A tech and AI-fueled melt-up carried stocks from the April lows back to record highs by summer. Sell in May. May through the summer was one of the strongest stretches of the year. The old seasonal map inverted. Crash in spring, euphoria in summer, all of it keyed to policy headlines instead of earnings seasons. When one person's announcements can move the entire market in either direction within hours, the calendar stops being the driver. It becomes the backdrop. So is the presidential cycle dead? Here's the honest answer. The mechanism is alive, even if the timing got scrambled. The incentive to engineer a strong economy heading into an election hasn't gone anywhere. If anything, an administration that moves markets by announcement has more throttle control than any before it. The pain came early and by choice. The incentive says the stimulus will too. That's not a prediction. It's the same incentive structure the cycle was always built on, running on a faster clock. Which brings us to where the calendar says we are now, a midterm year. Historically, the single most dangerous year of the cycle, and the single most rewarding one to survive. Because here's the statistic almost nobody quotes. Since 1950, from its low point in a midterm year, the S&P has gained on average more than 30% over the following 12 months. The worst year of the cycle has reliably produced the best entry points of the cycle. Every midterm year panic: 1966, 1974, 1982, 2002, 2022, looked, in hindsight, like a gift. So here's how I'd actually use all of this, and none of it is a prediction, it's how I read the board. Rule 1. Treat the cycle as a tendency, not a law. It stacks the odds, it doesn't guarantee anything, and 2025 proved a single policy shock can override any seasonal pattern in an afternoon. Rule 2. In a headline-driven market, respect the speed. Drawdowns that used to take months now take days, and so do recoveries. Waiting for confirmation means missing both. Rule 3. If history's midterm pattern shows up, a sharp, scary pullback this year, remember what that setup has historically been. Not the end of the world, but the sail of the cycle. Fear on schedule is opportunity in disguise. The market's calendar isn't magic. It's the shadow of political incentives cast onto stock prices 70 years running. The current administration bent it, compressed it, and turned it into a weekly show, but the incentive underneath hasn't changed since Eisenhower. Nobody runs for re-election on a recession. Trade accordingly. If you want more breakdowns where the data does the talking, money, markets, and the calendar patterns hiding in plain sight, subscribe and hit the bell, because I cover the numbers behind the headlines every week. And tell me in the comments, do you believe in the presidential cycle, or is it just pattern hunting in old data? The comment section here has been sharper than half of Wall Street lately. See you in the next one.